Okay, heroes, we're back. What is an options only covered put? So, first of all, if you have not watched the covered call video, you need to stop right now and you need to go back and watch the covered call video. Second thing, if you have not watched the covered put video, you have to stop watching this video and go ahead and watch the covered put video. Now, if you've seen both of those, let me introduce you to the options only covered put. So, again, not all the time do we see stocks down or stocks with high volatility, or we can have all these awesome strategies where we're just betting on the reduction of the implied volatility or the expected move. There are a lot of times where stocks are on the high end of their range and volatility is very low. Now, if you guys remember, or if you guys have been living under a rock, stocks are at the high end of their range, like SPY is right now, it's at an all-time high, and volatility is low. In this case, volatility is at an all-time low. We sell into strength. This is obviously strength, price is going straight up, and we want to sell into that, right? Remember, all of our studies show that selling into strength and buying into weakness is much, much better than doing anything else, right? So one of the strategies we can go ahead and employ is an options only covered put, right? So we'll get into exactly how you do it in a second, but what is an options only covered? This is spelled wrong. Covered put. Question mark. Right? What is that? Right? So an options only covered put is a synthetic covered put using options without purchasing stock. Right? Without purchasing stock. This is a bearish strategy, right? That benefits from a decrease in price or a decrease of implied volatility. Remember, we're selling a put against a long put here, right? And that short put that we're selling, that will lose value if implied volatility comes in. And it will lose value more than the long put because the long put is a much higher delta, it's deeper in the money, and there's far less extrinsic value that can be removed from that put. But we'll get to that in a second, right? So rather than selling 100 shares of stock, we're going to simulate this by purchasing a deep in the money put. So an in the money put, remember, is the price of the stock is below the price of the put, right? That is an in the money put, right? And we sell the put, that remains the same. So let's look at these and see what's going on here, right? So if you remember back to covered put, we can sell 100 shares of stock, or we could sell 100 shares of stock and sell a put at the same time, right? Doing this allows us to improve on our cost basis. So if in this case, if SPY goes up 1 penny, we'll be a loser if we're selling stock outright. However, we have about $3.32 as a cushion here. As a cushion, if we're selling a put against our stock, that moves our cost basis to 258.24. So we have a 50% chance of making money just selling stock outright. Now we have closer to a 65, 66% chance of making money when our cost basis is all the way up a little bit over 258, right? So again, big difference there. This is just short stock. This is a covered put. Now, an options only covered put is doing this with options. So what we like to do for that is we like to go to the monthly expiration cycle closest to 100 days from expiring, right? In that case, that monthly expiration cycle is the January ones expiring in 97 days. We want to go to a deep in the money put. The put we like to do is the 80 delta put. So we're going to go ahead and buy that, right? We're going to go ahead and buy that. And the same thing holds true for selling the put. So we're going to go to the monthly expiration cycle closer to 50 days away, and we're going to sell that same put that we did on the covered put with stock. So I'm just holding down the control button, I'm hitting the bid, and now this is going to be a diagonal. We call this an options only covered put, right? So we get close to the same synthetic as selling 100 shares of stock when we purchase a deep in the money put. In this case, it's the 263 put. And again, we're improving our cost basis by selling a put against it, right? So in this case, we're improving our cost basis by $3.32, right? So the interesting thing to note here is if we sell 100 shares of stock outright, we're short 100 deltas, right? If we sell 100 shares outright and we sell the at-the-money put, in this case, we're only short 53 shares. Now, if we buy the 80 delta put and then sell that at-the-money put at the same time to create an options-only covered put, we're only short about 35 shares of stock, right? So again, this is in a big way improving our cost basis and also at the same time improving our risk, right? Because we're short way less stock here, right? We're short way less stock here. And the only reason that this is short 35 shares and this is short 57 shares is because we bought an 80 delta put. If we bought a 100 delta put, it'd be a different story, right? It'd be a much different story. So that is an options only covered put. So again, we want to go to the monthly expiration cycle closest to 100 days expiring. We want to go ahead and buy anything equal to or greater than the 80 delta put. I personally like the 80 delta put, but anything greater than 80 deltas, totally fine. So we're going to go ahead and purchase that. Then we're going to go to the monthly expiration cycle closest to 50 days from expiring, and we're going to sell that same put we normally would have on covered puts, right? And we know based off of 11 years of data that the at-the-money put is the best one to sell. So we're going to sell that with our long put. Now, a lot of you guys are saying, wait, we don't really want volatility to decrease. We don't want volatility to decrease on this because the value of both options is going to go down. True. However, the deep in the money put, the 263 put, let's go find it. The 263 put that we're going to go ahead and buy only has about $1.02 of extrinsic value that can ever be removed at any given time from the price of the option, right? So as long as SPY does not move, the most money that can be lost from this option is $1.02. However, if SPY doesn't move, the most money that can be lost on this short put is about $3.32. So if SPY doesn't move, right, so it's $3.32 is the most we can lose on the short put. And then if we go to that long put, the most money we can lose is about $1.02. So let's see, minus 102. So if SPY does not move at all, we're making $2.30 on this, which is really, really cool because if SPY doesn't move, we have a 33% return on capital since we're only putting up $6.18, right? So again, short 100 shares of stock, and sell a put, right? That is a covered put. Now we're long a in-the-money put to give us synthetic short stock, and we're also selling that put against it. Right, so those are like the three things going on here, right? So again, we have short stock, covered put, options only covered put, right? So we did a study to try to figure out what to do here, right? So we did 2003 to present, so 14 and a half plus years depending on when you're watching this video. So in SPY, we did two things every single day, right? So the first thing we did was we sold 100 shares of stock, and we sold the 50 delta put in the monthly expiration cycle closest to 50 days from expiring, and we did no trade management, right? We did nothing, right? We did absolutely nothing. So again, let's look and see how we did that, right? So we're short 100 shares of stock in the monthly expiration. We're short 100 shares of stock, and we're short the at-the-money put in the monthly expiration cycle closest to 50 days away. So the December right now expires in 62 days, right? This is the closest monthly expiration cycle to 50 days. We're going to go ahead and we're going to right-click, Analyze Sell Trade, Covered Stock. This is an example. This is an example of a covered put, right? Rather than having a cost basis of 254.91 on our bearish strategy, we have a cost basis of 258.42, which means we have roughly a 65-66% chance of making money. The reason why I know that is because, right, we find the option, we find the call that is equivalent to our price. In this case, it's the 258 call. Delta are the chances an option finishes in the money, right? We're short, so we want the stock to be out. We want the option to be out of the money, or the stock to be below 258.24 at expiration, right? Because that's our cost basis, right? So if 258 has a 35% chance of finishing in the money, it has a 65% chance that it does not, right? So we have about a 65% chance of making money on this trade, right? So that's the first thing we're going to do. And the second thing we're going to do is we're going to go ahead and do one of these options only covered puts. We're going to go ahead and buy the 80 delta put in the monthly expiration cycle closest to 50 days. So let's go ahead and do that. We find right there, January, let's go to the 80 delta. We're going to buy that. Great. And then at the same time, we're going to sell that same at the money put in the closest monthly expiration cycle closest to 50 days away, right? And we're going to do this and we're going to hold it to expiration, so no trade management here. So we're going to go ahead and we're going to hold in the control button, click on the bid to sell, and right there, right? So big difference here. In a margin account, 100 shares of SPY would be about $25,000 right now. Excuse me, in a cash account. In a margin account, if we were to be short 100 shares of stock, it'd be about 13 grand. However, we can get our synthetic equivalent with an options only covered put for about $618. So you can tell the return on capital is drastically different here, right? To get very much the same directional bias, right? So that's what we did. So we did these two strategies and we just did them every single day. And we didn't manage any of the trades, and we didn't make known of volatility, but we wanted to see what's the best strategy. Now again, both of these strategies are bearish strategies. They're bearish strategies. We put on bearish strategies when stocks are high because we like to sell into strength, and it's even better when volatility is low. If we look in SPY right now, we're looking at all-time highs in SPY and all-time lows in volatility. This is an excellent opportunity to put on a bearish strategy. Both of these strategies are bearish. I want you to make note, though, that when stocks go up and up and up, these bearish strategies might not be the greatest thing ever. So it's very impressive. It's very impressive here that we're able to make money in both of these strategies that are bearish strategies in a bull market, and not just a bull market, a serious bull market. So the covered put, which is selling 100 shares of stock and selling the at the money put against it and no trade management, we're right about 48% of the time. We make about $35 per trade. Our average margin requirement is about $15,000, and our average return on capital per trade is about 0.24%. Not bad. Again, you have to consider this is a bearish strategy. There aren't a lot of strategies that are even more bearish than a covered put. And we were able to make that into a profitable strategy in a big time bull market. So that's just a big deal. Just before we get to the next one, because I see everyone's eyes are looking at the bold characters at the bottom right here of this chart. But the options only covered put, which again is buying the 80 delta put in the monthly expiration cycle close to 100 days and selling the at the money put against it to improve our cost basis, to significantly reduce our risk, give us more chance to be right. If selling the at the money put in the options expiration cycle close to 50 days away, right? We're right 46% of the time. We make about $39.91 per trade. So the same amount of money as we do per trade on a covered put. However, this is where things get really interesting. The average margin requirement on a covered put for that 14 and a half plus years was about $581, right? So the fact that we made the same amount of money is great, except rather than having a 0.24% return on capital, we're looking on average a 6.87% return on capital. So a big deal. Remember, buying that in the money put is very close to selling 100 shares of stock, because buying the in the money put gives us a 80% of a synthetic movement of short stock, right? So again, covered put, it works. It's a bearish strategy in a bullish market. The options only covered put It works. Again, it's still a bearish strategy in a bull market. However, because of the capital requirements with options as opposed to stock, you're looking at a 28.625 times improvement in return on capital when we're doing the options only covered put. So if I look at SPY today and I go, shit, it's at all-time highs, right? So we want to sell in the strength. Volatility is all-time low. Volatility is a mean reverting asset. So when volatility really gets this low, it reverts back to the mean, or in this case, it will go higher. It might not get there tomorrow, but it will get there at some point. What comes with that is lower prices. So bearish strategy is perfect. So what I would do is I would go ahead and execute here rather than a covered put, just because, as we know, both strategies work. However, one is 28 times better. What I would do is I would go to that monthly expiration cycle closest to 100 days. And I'd go ahead and I'd purchase that 80 delta put. I'd go to that monthly expiration cycle close to 50 days away, and I'd sell that at the money put against it. That's what I would go do in this. And actually, probably on Monday, I'm going to go ahead and do that. Right? It only cost me $618. The average trade doing that every single day was about 6.87% return on capital. Maybe another time I'll do it just when stocks are like really, really high. But again, this is super, super powerful stuff. Just by using options as synthetic stock, we turn this from a profitable trade to the same profitability, however, 28 times more effective in terms on return on capital. So when stocks are high and volatility is low, options only cover put. I'll see you on the next video.